All right. Well, hello and welcome, everyone. I'm Lauren Adams, and it's my pleasure today to welcome you to the CFA Society of Detroit webinar. We have a great lineup of events planned for you this year, and hopefully, if this webinar is any indication, with over 250 members registered, you will agree to. So, to that end, if you haven't heard already, I want to make sure some of our next events are on your radar. And do not miss our next in-person event that will be held on April 17th at the Townsend Hotel in Birmingham. The topic is a masterclass in due diligence and will be in a panel format featuring several of our CFA members and other national experts. Then on May 1st, we have a Women in Investment Management event co-hosted by ACG Detroit, the Association for Corporate Growth. And we're really excited about this new collaboration and hope to bring more co-hosted events with them to you in the future. And last but certainly not least, this spring is a perennial favorite, our annual meeting and golf outing, once again hosted at Oakland Hills. Don't miss the chance to be part of this special event. Now, let's turn to our feature presentation. I have the honor of introducing you to our speaker today, Meb Faber, backed by popular demand, who will be talking about opportunities in shareholder yield investing. After Meb's presentation, you'll have the chance to submit questions through the Q&A function of the webinar. And there's a link to the slides in the presentation available in the chat. Thanks, Michelle. Now, Meb Faber is a co-founder and chief investment officer of Cambria Investment Management. Meb is the manager of Cambria's ETFs and separate accounts. He is the host of the Meb Faber Show podcast, of which I'm a huge fan, and has authored numerous white papers and leather-bound books. Meb is a frequent speaker and writer on investment strategies and has been featured on Barron's, New York Times, New Yorker, among so much more. Welcome, Meb. Thanks for being here again. I'll turn it over
What's
to you.
up? Great to be
Thanks.
here, guys.
Well, I'll turn it over to you. Yeah.
Awesome. Wonderful to be here, everyone. I'm sad I'm not there again in person. A lot of fun last time, although it's March, so a little nice here in Los Angeles rather than being in Michigan. But the format today, I think, would be really fun. I'm going to cover one topic pretty quickly. And then for those of y'all who know me, know that I love to talk about a lot of different ideas in macro, and there's really a couple that I think that are pretty interesting, including a fixed income paper we just put out. But we're going to stick on one topic, and again, encourage people, throw in Q&A now throughout the presentation, and we can hit all this near the end. And I tend to go pretty fast on this. Don't worry about the slides. We've made them available to the society so you guys can review them later, or certainly email us and ask for questions or follow-ups as well. So the intro covered most of the stuff. My day job is managing Cambria funds. We are an ETF manager. However, we do put out a lot of content on places like Twitter, where I was usually getting in some scraps and fights. Research, we do a weekly email. If you don't get it, I don't write it anymore. It goes out to 100,000 people. It's called the Idea Farm. It's free. It's a one email every Sunday. Usually the top two institutional research pieces and top two podcasts, along with some other links each week. It's really an awesome resource. We mentioned the podcast, over 500 episodes now. We got some really fun shows coming up. Do not miss recording one next week with Cliff, which should be a banger. The blog at this point, I don't even know how many posts in the archives there are, over a decade, and probably 5,000 at this point, but you can find some stuff in there too. Again, my day job, we're ETF manager. We're over a decade old now. My goodness. We manage 14 ETFs, about $2.5 billion in assets, over 150,000 investors, which is pretty cool. I imagine a couple of people on the podcast, on the webinar, hopefully, across all sorts of disciplines. It's rules-based, quantitative, etc. Happy to talk about those later. So the theme of this webinar is, damn, it's been a good time to be an investor the past 15 years. Holy moly. If you talk to clients and they've been a client for the past, really since GFC, which is an investing lifetime for most people, you've had an awesome run. Most of us in the US put most of our money in US stocks and bonds, and of that, most of it's in US stocks. And US stocks have done 15% per year for what is this now? Trying to do internet math, 15 years, I think, as of this month, probably as of like today, the bottom in 2009. And so, a lot of people out there are fat and happy. They're extrapolating these returns into the stratosphere with a Starship rocket up there today. And the bad news is their expectations are probably also 15% a year. So for those of you listening who are also asset allocators into a crazy thing called globally diversified asset allocation, really any portfolio. We wrote a book on this a long time ago called Global Asset Allocation. It's free online. They looked at all the various global portfolios, like permanent portfolios, 60/40, endowment style, risk parity, on and on and on. Basically, it's been the worst stretch ever for a thoughtful asset allocation portfolio relative to the S&P, in both in terms of number of years in a row down into 2022, as well as magnitude of underperformance. So this chart may either be painful or meditative for some of you, but as you look back on history and say, hey, 15% returns, is this, quote, normal? Yes, it is happened. So it is, I guess, quote, normal, but is it typical? And not really, because there's only been 4 periods in history where you've had these rolling 10-year stock returns do as well as they have. And they all have names, which I don't know if it's a good sign or bad, but you had the roaring 20s, which sounded like a pretty awesome time. You had the nifty 50s, the internet bubble where I cut my teeth in the late 90s. And then, of course, whatever you want to call this, meme stock mania, COVID period. Now, on the flip side of that, you had periods both preceding and after, where if you look at, the crash before the 1920s, you had the Great Depression, the inflationary 70s setting the stage for the Great Bull Run in 1982, and then the internet crash followed by the global financial crisis. Well, all 4 of those, you had rolling stock return periods of 0 to negative. So this chart to me is a pretty good way to step back and take a look and say, okay, where are we probably in this cycle of secular tops and bottoms? And certainly we're not at an 08, 09 or an early 80s, but rather probably the opposite. A lot of people say, yeah, but this is just because of low interest rates, SERP, NERP, all that good stuff. Well, you can do this for Sharpe ratio too. Sharpe ratio, risk adjusted return for markets. Almost every market over time has a Sharpe ratio of 0.2, 0.3, long only. So we're talking US stocks, foreign stocks, bonds, real estate, on and on and on. And if I was to tell you the S&P had a Sharpe ratio of 1, you'd be like, that's crazy. Of course it doesn't. That's what I pay my hedge funds for, 2 and 20. Or if you said it has a negative Sharpe ratio, you'd be like, well, that's not normal. So this chart, if you kind of flip back and forth, it's like the same mountain range, but just different peaks. So risk adjusted, it is in line with the others where it was just as nutty. I thought 2021 would be the peak nuttiness, but it seems like we may be rekindling those animal spirits here as well recently. We'll see. Not surprisingly, a lot of indicators correlate when you look at long-term stock market returns. So everything is sort of driven by price. And then you have the knock-on effects, the cousins, the mirrors, the shadows of really the other indicators. So this one is valuation, the famous Shiller-Cape ratio, but it doesn't look that too different from the prior 2 charts. You can see the local maxima of the 1920s, the nifty 50s, the internet bubble, as well as the recent COVID meme stock era. And now this chart is actually, it looks like it's a little bit out of date or it got cut off because, yeah, it's a few months old for some reason. Gonna fire the intern, but this number is back up to like 38, I think, is where we are. No, 37, somewhere. It's high 30s. I'll do a number check before the end of this and make sure but it's not cheap. It hasn't exceeded the COVID mania, and then the highest it's ever been in the US was when I was in school and it hit for almost 45. Now, the flip side of this, of course, was also Japan. If you guys remember, Japan is in the news a lot lately, not just because of the good shows of Shogun and Godzilla winning an Oscar, but rather because their stock market just hit a new high for the first time in 30 years, which is absolutely nutty. But they hit a long-term PE ratio of almost 100. So the biggest bubble we've ever seen in equity markets. The good news is, most of the time it's around this average level of around 17, 18. If inflation is low, it's allowed to be in the low 20s. You had a screaming buy opportunity in 2009, kind of got to the low teens. And most countries around the world right now are totally reasonable. There's a couple that are kind of on the expensive side, the US being one. I don't think this is a bubble. 40 in my line is kind of my line in the sand. Anything above 25 to 40 is just sort of various levels of expensive. But you have that now. You're about to tip into bubble territory for sure. But other countries hit it over time. China and India, famously emerging markets, which I was humorously tweeting about on Twitter a couple days ago. It's funny to see the reactions. Anyway, price to earnings, sentiment, valuation, they all tend to rhyme. And so usually when markets are at new highs, valuation's super high, the sentiment is also usually super high. If you look at what's going on in India currently, India has decoupled from China and has had spectacular returns and is on the precipice of passing China in market cap. But man, the Indian population is going nuts for options and everything else, just like our retail crowd did. And has and continues to do. Anyway, US stocks are expensive. So the thing is like, how many times on TV have you heard like it's a stock picker's market or it's a market of stocks, not a stock market? And if you think about, it's easy shorthand to talk about the S&P 500, right? Because you have one number, one explanation, people understand it, it's market cap weighted, and it's cheap. You can get it essentially for free. Now, the problem is if you think of market cap weighting, an incredible invention 50 years ago, my God, it's done more to change the investment industry than almost probably anything else. John Bogle deserves to be on the Mount Rushmore of investing, national hero. But it's not the actual market cap weighting that was the massive innovation. It's what market cap weighting allowed, which is it allowed low cost investing because you don't do anything. You literally do nothing. You buy a portfolio today, you literally in a market cap weighting other than IPOs and corporate actions, you do nothing for 100 years. So you don't have to charge that much. But market cap weighting itself, it's sort of like the dummy's guide to investing. It's a decent way to invest because you're guaranteed to own the winners and the losers get smaller and smaller percentage of the overall pie. But it's a curious way to invest because if you ask your clients or your niece, nephew, spouse and say, hey, we invest in the broad-based index, what's that based on? Usually I think it's a telling discussion because most people say, well, it's the biggest companies, it's Apple and Nvidia and everything else. And you say, yeah, but biggest by what measure? And it turns out it's biggest by only shares outstanding times the price of the stock. Now, that's a weird way to go about picking companies because it has no tether to fundamentals. And so the Achilles heel of market cap weighting is when things go nuts, you put most of your money in the most expensive things. It's not always the most expensive, but it's the things that have gone up the most. So think about Nvidia, about to become a $3 trillion company. Well, maybe, I don't know. I don't want to jinx it. Which is no other part of your life do you invest based on just price, right? You invest based on buying a house. It could be various ratios of the valuation to square feet or on and on and on sort of things. So if you think about it and you say, okay, we live in a world of ETFs that allow for active management, so we can do any sort of rebalancing method and it'd be tax efficient. Is there a better way of creating an index to give us this US stock market that's not market cap weighted and by an extension foreign and emerging and any other sector, industry, real estate, whatever? And so we obviously think there is. This graphic is from our first book over a decade ago. called Shareholder, not our first book, but it was a decade ago, which called Shareholder Yield. It's free. We're trying to write an update now, but the concept was that if you're looking to invest in companies like a very Warren Buffett type of strategy, if you take a step back and say, what can a company do with its cash in the first place? Well, what 99% of media and people spend time on is reinvesting in the business. So new iPads, is NVIDIA building new chips, is Tesla rolling out a new service, on and on and on, right? That's the sexy part. And but really, there's other parts of the CIO's job is to maximize these various levers to come up with the best ROI. So they could go merge or buy a company if they want. If they have a bunch of debt, they can pay it down. Or if they don't know what to do with the money, they can return it. And so that means a cash dividend, which everyone loves, or buying back stock, which everyone doesn't understand. That's it. You have no other choices. This is your menu of 5 ideas. And some tend to be value destroying and some tend to be great use of money. Now, buybacks, my God, talk about making people's brain misfire. Buffett, more than anyone, has talked about buybacks. I mean, this is 40 years ago? He's talking about buybacks. So the thing is about buybacks is buyback and a dividend, if a stock's trading at intrinsic value, are the exact same thing. You can't argue that. Finance 101. Buyback, if you could reframe them as tax efficient dividends or flexible dividends, that's a much more thoughtful way to describe them. We have a lot of research we can point you guys to that talk about cash usage, dividends, buybacks, going all the way back very far with both factor-based research. Anyway, resources we can send out to you guys later. But Buffett's got a great quote: when companies with outstanding businesses, comfortable financial positions find their shares selling far below intrinsic value in the marketplace, no alternative action can benefit shareholders as surely as repurchases. That's quite a statement. Now, the key phrase in here is selling far below intrinsic value. So what Buffett does is he goes out there and he says, I'm going to buy Berkshire at 1.3 times book. So he's got a quantitative line in the sand. Last thing you want is a megalomaniac CEO thinking his stock is always cheap and buying it all the time. So you want it to be when it's reasonably priced. Here's another quote. I mean, these are getting old now, but it's true, where JP Morgan was talking about the single best measure of value is shareholder yield. So the way we define shareholder yield, and others do it differently, there's 2 main components: is paying out a cash dividend and net stock buybacks, okay? And net stock buybacks is important. So net issuance, because share issuance, it's like a value strategy, right? So value people buy cheap stocks, but by doing so, they also avoid the really expensive. Ditto with buybacks. It's not just that you're buying back stock, it's also you're avoiding the share issuers. So particularly in this cycle in the US, so many companies, particularly in this tech sector, are issuing a ton of shares through stock-based compensation. And stock-based compensation, they then say, oh, we'll do a buyback. But if you're issuing 5% in stock-based compensation and you're buying back 5%, guess what? The net effect is 0. So that doesn't do anything. You're just transferring more and more cash and money to management and CEO, C-suite, which at some point was about 20% of tech revenue in the past few years and is a very real cost. So anyway, we wrote a book on this topic over a decade ago, Shareholder Yield, and said it's a better way to sort for stocks because there was a very real inflection point in the 1990s where companies now buy back more stock than they pay out in dividends. And so why would you only look at dividends? That's insane. And to ignore this piece of information about shares outstanding, what's going on. So this isn't going to be a product pitch, but there's no other way for me to talk about shareholder yield and some of the metrics without mentioning our funds, because there's no other shareholder yield funds. It's been over a decade. I've been waiting for someone else to launch one. We got money in the office, whether it's going to be Vanguard, BlackRock, State Street. It looks like it might be First Trust as the winner here. But so we've launched a suite of 4 shareholder yield funds. They all go down this same path, and I think this is helpful to think about it. So you guys could do this on your own. There's screeners, the book. but as an illustration of how to think about a good screen for stocks. So you start out with a broad universe. In this case, SYLD is US stocks. You look at dividends and buybacks. Okay, so here's a fun way to think about this. What's the dividend yield on the S&P? It's like 1.5. It's like near all-time lows. The average stock in the broad US stock market is a share issuer. So that's a negative yield you're tacking on to your dividend yield, which is crazy. So there's stocks out there that my dividend friends will go and buy and think they have a good 3% yield. And guess what? They're issuing 5% a year in share issuance. So they actually have a negative 2% yield. Like, talk about a thing like a client sitting down with a client, be like, yeah, you have this nice, safe dividend yielding stock. And they're like, well, yeah, but it issues 5% a year in shares. So we're actually, you bozo, you bought me a negative yielding company. Why would you do that? Anyway, the average companies that enter into a shareholder yield screen are usually double-digit shareholder yield. Now let that sink in. So most of the income funds, hot and bothered if they yield 4% in the US, right? And so in foreign, developed, and emerging, we'll get to that in a minute, but the valuation, we liked it to be run a valuation ensemble. On average, the shareholder yield companies are going to be trading cheaper, just like the high dividend yielding companies would be. But I don't want that to be a exhaust of the process. I want it to be an explicit part of the screen. So we do a valuation ensemble to be able to say, hey, we want to be able to actually make sure these stocks are cheap. And it doesn't really matter the metric. We think price to cash flow, enterprise value to EBITDA, even though Munger hates it, even price to book and price to sales are probably fine. Quality is one that is probably, I don't know if it matters to the process that much, but in general, quality keeps you out of the ones that are just loading up their balance sheet with a ton of debt to distribute the cash. Particularly during ZIRP, that was a thing. I bet it's less so now that stocks yield 5%. And so that leverage part as well. And then the kind of the debt pay down metric as well. Anyway, that's one way to think about how to go down this. You could just do dividends and buybacks and end up probably in a similar place as you would with the whole process. But this one is a little more nuanced, but everyone can design it their own way. But I want to show you what this kind of results in as far as some of the metrics. So if you look for dividend and income, and you would compare, say, our fund to the category average of the S&P, you'd say, Meb, that's not that interesting. It's got like a 1% yield. Granted, the category and the S&P aren't that interesting either, 1.5. But the whole point is this buyback yield is hidden. Most of the websites, Morningstar, Yahoo Finance, YCharts, you have to really, dividend yields on the front page, but you have to dig to go find this sort of share issuance buyback shareholder yield. And so it's embedded in the total returns. So this fund, for example, over the past decade, has not only kept up with the S&P, it's outperformed a little bit, but it's done much better than the category. And these are kind of disclosure slides you guys can look at later. But this is sort of if you guys are sleeping, this is the slide to wake up for. And again, this isn't meant to be about our fund. You can go to Morningstar, type in any symbol you want. I love to pick on VIG, $70 billion ETF now. I started picking on it when it was 20. So what do I know? But Morningstar, and then hit holdings, and it'll show you a snapshot of the valuation and other metrics. So for example, if you throw in shareholder yield versus the mid-cap value category, which is where it hangs out, and the S&P, you can see not only is shareholder yield cheaper than the S&P and the category on every metric, it is substantially cheaper. So a single digit price to earnings ratio versus the S&P, which is almost triple, and ditto for most of the metrics, right? So you have this massive value spread, and you say, well, why isn't the mid-cap value category cheaper? Well, you say that's because a lot of the traditional mutual funds, legacy giant funds are closet indexers, right? They want to be different than the S&P, but just not too much, because that feels uncomfortable and you look different. Now, the crazy thing, and so all the other big quants have talked about this, Cliff and Rob and Jeremy Grantham and everyone else, Ben Inker, this value spread, right? This value trade, values underperform growth for the majority of the post-GFC. But when you say value, it sort of depends what you mean, right? Like there's not one true definition of value. It's not just a French Fama price to book. Like shareholder yield is value, but it's actually, as you saw on the previous slide, has kept up with the S&P. And so, but the crazy thing is, so everyone's like values in the top 10% decile of history, which is a pretty good place to be if you're a value investor. But this chart shows the PE ratio spread relative to the overall market and category. And all I want you to see is this general trend, right? The spread has widened, which is crazy because if you look back at this to me, like, okay, it's traded at a 20, 30% discount. That makes sense. And then over the past 5 years, and despite value bottoming in 2021 is my belief. I think when we look back and I'm hanging out in Detroit in 2030 and we're saying, when was that inflection point for value? And I think we'll say 2021 rather than today, but it did continue to widen into 2022 and really, I think probably bottomed at the end of 2023. We'll see what this year brings. But to me, this slide screams, look, value is going to have a monster run this decade. Other people will look at this and say, no, value's broken, you're an idiot. But if you're not going to do value now, you'll probably never do value. Or said differently, you may chase it in a couple years after it outperforms by 100 percentage points like it did in 2000 to 2003. But to me, I love this chart. It's one of the most interesting charts in all of investing right now. I don't want to talk about the funds too much, so I'm going to skip over. I just want to say that the same general trend is true in foreign markets. So we have a foreign developed, which is FYLD. We have a foreign emerging, which is EYLD. And these general markets have the same general setup. Again, you guys can look at this later, but the metrics, the only difference between the US and foreign is twofold. The foreign broad markets are cheaper than the US. No surprise, foreign markets have underperformed the US since 2009. So the actual market cap weighted index is cheaper, but the cheap high quality stuff underneath is even more cheap, right? So single digit P ratios. The big difference is if you look at the dividend yield, you're like, whoa, Meb, well, in the US, you had this 1% dividend yield. Here it's 5. What's the difference? Well, historically speaking, culturally speaking, companies in foreign developed and emerging still have more of a tilt towards dividend than they do buybacks, although that's changing. You've heard about it a ton in the media over the past couple of years about Japan, how they've become much more shareholder friendly, focused on governance. We've seen that in the portfolio. Lots more Japanese stocks are screening. And look at this, price to book at around 1, price to sales half of 1, which is pretty cool. So we see the dividend buyback split closer to 50-50 in foreign developed and emerging versus US, which is closer to like 20-80 in favor of buybacks. These funds have done well in general, the same general trend, right? Trades at a persistent discount. That discount has widened over the past 3 or 4 years. Ditto with emerging markets, same general statistics you can see, which are pretty exciting. I think emerging markets at this point, so if you look at global market cap, it's US 60, foreign developed 30, emerging markets 10. And I made the mistake of talking on Twitter about emerging markets. I said, emerging markets, 85% of the globe's population, 60% of GDP, might even be 65% of GDP. So the majority of the world's GDP. US is only 25. A lot of people don't know that. Emerging market cap weight is 10. And I bet if we did a poll here, the average investment in your equity portfolio in emerging markets is probably rounds to about 2%, which essentially rounds to 0. So I think it's a pretty interesting time in emerging markets. The big discussion has been around China, which I'm happy to get into a little bit more as well. But again, it goes back to how you index. So if you were an indexer in emerging markets, you had all your money, but not all, you had 30, 40, 50% in China, which is down, I don't know, 60% or more. And this fund has largely avoided China. And you can see the valuation, same general trend. And China now is at some of the lowest valuations ever been. It helps that it hasn't gone anywhere in 30 years, similar to Japan. I'm going to wind down. I wanted to save a ton of time for questions and topics. I cranked in right at 30 minutes, so we can talk about all sorts of other stuff. You guys seem to be quiet over there. You need to get some Q&A in to help out Lauren and everyone else. But I will cut off my mic now, and then we can talk about some other stuff.
Thank you, Meb. And it's just great to hear your thoughts and, especially what you think is most compelling, as you shared. So with the Shiller Cape ratio, I think we're at 34, which is, the intern left off earlier.
Oh,
But
that's not so bad.
so, but it's interesting to know that, you kind of see we're in the expensive territory, not necessarily the bubble territory. But even with that, I mean, what catalyst do you see, for a change to US secular dominance?
Um, who knows? When we talk about catalysts, it's always obvious in retrospect. So let's rewind to the year 2000. I was a little engineer student. My professors were trading stocks in class. We got Cobalt, Lucent, CMGI. You guys remember some of those names, the older crowd. Um, and I was a biotech student, so I was knee deep, neck deep probably in biotech stocks. And there was a big biotech bubble, just like the internet bubble. I think a lot of people don't remember that. And we were sequencing the human genome. And I was on spring break in Jamaica. And I remember Bill Clinton came out and gave a speech, and he was like, well, it's illegal to patent the genome, which everyone knew and was not particularly news, but it was an excuse to sell off. And I think by the time we got back, biotech stocks were down like 30% or something.
Mhm.
And that kind of just was like, as you look back on it, you're like, was that a catalyst? Like, I don't know. Like, that seems really foolish. I think when markets are very expensive, they become very fragile to almost anything. Now, if you look back in history, these things can certainly get nuttier. So, in plenty of other examples, both China and India in 2007 were trading at PEs of over, I believe, 50. And now China's in single digits, and India, of course, is up around 40 almost again. So um, you have this sort of totally bipolar markets where there's always something in the world that's either in a bubble or in a huge depression. I don't know. Like I could give a few hypothetical examples. The first would be simply um, we got a little election coming up this fall, but like you could play out how like that could be kind of a weird time. It could be contested.
Yeah.
We get these two octogenarians into the fighting ring together. Who knows what's going to happen? You have potential return of inflation, which seems to be stickier than I think people expect. So if inflation starts ticking up, that's like everyone's worst nightmare. The average PE ratio, CAPE ratio, when inflation is tame, is like 22, 23. But when inflation is high, so north of 4%, like we're hanging around right around 3 now. Um, so if we had a similar situation in the early 70s, the average PE ratio isn't 22, 23, 17, it's like 12. So 34 to 12 is a long way. So you could easily say, make the case that if inflation started kicking back up, you could have 50% decline in stocks. But that's not out of the question. And the funny thing is, like, when you talk about asset classes, I think if stocks were down 50%, people would be losing their mind. Twitter would be probably a pretty even more unpleasant place than it is today. But if you look at bonds right now, fixed income markets, I don't think most fixed income investors appreciate this, but if you hold a portfolio of fixed income, you're probably down right now, depending on what you own, somewhere between 10 and 50% drawdown. So fixed income just is in a massive drawdown, and the long bond particularly has just been getting whacked. Now, the crazy thing, and we just wrote a paper on this, so I'm just going to kind of pivot to my own question and answer. It's called T-bills and chill most of the time. And I say you have this weird situation where T-bills right now are 5% ish. Let's use that for just rounding error. And historically, if you take more risk, so in a term or default premium of 10-year, 30-year bonds, or in corporate bonds or junk, or even more esoteric bonds like emerging markets, TIPS, even quasi-income instruments like REITs, historically, there's a yield spread premium over T-bills. And so for stuff like the 10-year or 30-year, it may only be 1% or 2%. For stuff like junk bonds, it may be up much higher, 3, 4, 5, 6, 7% over T-bills. Well, right now, most markets either have no or negative spread to T-bills. So what everyone calls the inverted yield curve in the US on the government bonds. Um, and that doesn't make a whole lot of sense to me to be investing in riskier bonds if they yield less than T-bills. So we did a simulation in this paper. This is actually the foundation for a new fund we just launched called TYLD, where we said, what if you only invested in these riskier bonds when the spread was in the top half of history? So you go back 100 years and you say, we're only going to invest in the 10-year or corporate bonds or the 30-year when the spread rewarded you. And it turns out, not surprisingly, you end up with better returns, lower volatility, and drawdowns. And if you did the opposite, only invested when the yield was less or in the smallest half of history, you underperform T-bills. Like, it was a terrible idea. And so you can devise a strategy that would say, hey, I'm just going to hang out in T-bills until one of these various markets, the spread starts to reward you. And so right now, our fund that launched, which actually has a 0% fee waiver right now, it's small. I think it's like 10 million, just came out in January. That fund is 100% in T-bills because most of these fixed income markets, either one of three things needs to happen. T-bill yields need to come down a lot. So at least 100 basis points, maybe two. Long bonds or these riskier bonds, yields need to go up a lot, or both, right? They could both move before we would move into any of these fixed income markets. And the reason I mentioned that is in the second scenario where some of these yields go up, these large losses on fixed income get worse. And so we're already at, I mean, a lot of people don't know this. If you look at nominal bond drawdowns, but also real bond drawdowns, usually it's the inflation that whacks these bonds even worse. Bonds are just as risky as its stocks if you look at total drawdowns after inflation. Most people look at T-bills and say, well, they've never had any losses. Well, I say that's on a nominal basis. If you look at a real basis, they've actually declined by half before. And so some of these bonds are at, near, or exceeding historic maximum drawdown levels. Now that makes sense because we've gone from a zero or even negative interest rate environment to now one where we have yield again. But even then, it's not compensating enough. So there's potential more pain in the bond world, which I'm surprised there's not more stress. I mean, there's banks failing, certainly, but it's not sort of a lot of them. I'm surprised there's not more stress in the system. So to your answer, it could be elections. It could be continued wars in Europe and Asia. It could be inflation is the one that probably would I think, be painful the most to anyone. And then last, it could be simply stresses in the system from going from a 0% interest rate environment for many years to one that's significantly higher.
So thinking about what you just shared about bonds and zooming out more, given the 15% returns that you've said we've seen recently in the stock market, is, many of us are advisors and we manage balanced portfolios, and really the equity side has been the workhorse for client portfolios and returns to meet their goals. And I know we're getting more excited after living through this bond drawdown about the outlook going forward for bonds and helping finally be a contributor to portfolios. But I guess I'm here in maybe starting from a higher valuation for equities than we were over the recent terms. So do you see bonds being a better contributor than they have, or some of the
Yeah, it's always funny when you talk to investors, because we said this on TV the other day and then on Twitter. I said, it's been last year was an amazing year for stock investors. I said stocks were up, and I forget what were stocks up last year? 20%? I have no idea.
26, yeah.
I was like, stocks were up 20%, 26% last year, which is an absolute terrible outcome for young investors, right? And like the young part was important. Old investors, amazing outcome. Young investors, like, nothing's better than the market going down and staying down for 10, 20 years, right? Your dollar cost average into these very cheap markets. So it depends on your perspective, right? Same thing with fixed income. Like, I feel like if you're now a retiree, you feel like you've won the retiree lottery. Pina coladas on the beach in Cancun, man, 5% interest rates, risk-free, seems like a pretty nice opportunity set. And that becomes sort of the bar, right? People love to compare stocks and bonds for whatever reason, good or bad. but bonds aren't risk-free, as we just talked about. They can be painful. I think really going to the opportunity set with anything, um, it's hard to be asset class agnostic. Almost everyone gets attached to a certain asset class or style. The gold bugs, from y'all's friends up a little bit more north in Canada. If you got any Canadian buddies, probably own a huge portion in gold. The young cohort, right, owns probably the modern digital gold cryptocurrencies as they're hitting all-time highs. We wrote a paper on all-time highs, which is kind of fun. If you guys haven't seen it, it's also on the website. Um, and uh, and so everyone becomes attached. And so once you become attached, there's a very different mindset emotionally than when you did not have an investment, so it's hard to be asset class agnostic, to be able to say, hey, look, um, I'm not going to bring in my emotional baggage to investing, and here's the kind of swath of global portfolio. So I think fixed income, it certainly looks a lot better than it's zero. Like, to me, we're going to look back on that and say that was a weird time. I mean, it was definitely a weird time with people trading these meme stocks. It's a weird time right now in India with everyone trading options and zero-day options everywhere. It's always a weird time in markets, SPACs. But it was certainly a weird time to be having negative yielding bonds across Europe and other places. Like, why would you ever invest in those? I don't know. It's such a strange phenomenon. Anyway, but if you're a global index investor and you invest in things like the ag or these globally market cap weighted indexes, you get everything for better or worse. So the opportunity set right now we think is awesome. However, the average American puts all their money in US stocks. So listeners, I'm not going to ask you to do a poll because I've done this 100 times and the answer is always the same. It's going to average out to you guys have about 80% of your portfolio, US, 80% of your stock portfolio in US stocks. And it's probably now drifted up to about 90%. The global market cap weight is 60. Okay. So that is a massive overweight. At 60, you're already 10 times the size. The weight to the US is 10 times the size to any other country. Now, remember, my largest fund is a US stock long only fund. Nothing would benefit me more than US stocks going up forever. But the reality is the market cap weight is expensive. And so the opportunity set of looking, 75% of the best performing stocks each year are outside the US. So looking beyond your shores, we did one more story and then I'll kick it back to you. We went on TV the other day and everyone wants to talk about NVIDIA all day long. NVIDIA. 2, maybe $3 trillion company. It's been going straight through the roof. And it's a great story. I mean, the success and growth of that scale is pretty awe-inspiring to watch. I said, however, what if I told you there's a semiconductor stock that's outperformed NVIDIA since the beginning of last year? That's probably a household name, right? And I said, do you know how many tweets there's been about this stock this year? There's been one tweet on Twitter this year. And this isn't a small company. It's a multi-billion-dollar company. It just happens to be located in South Korea. Full disclosure, it's currently the largest holding in our emerging market fund. A lot of people love to talk about, well, the problem with value strategies in the US, the reason they missed the boat is they've avoided tech, which is simply not true in the first place. Now, on average, probably most are under allocated to tech, but as is our strategy, in emerging markets, tech is the largest single sector, which I think is a really interesting description of what's going on because stocks are so cheap there. The tech companies actually look great. And we held Apple for like 10 years in our fund. So it's not that we avoid tech. It's just right now in the US, most of the tech stocks are expensive. And particularly in the US, they do a ton of stock-based compensation, which results in share issuance and dilution, which nobody wants. Sorry, that was a long answer.
No, it's great. Similar to what you were talking about at the end, we had a question from the audience about when is the right time to invest or go back into China, given all the potential issues going on.
China elicits probably more emotions than any other topic right now. And, China is also been somewhat of a basket case the past few decades where almost no other country has really oscillated between everyone loving China, euphoria, clamoring for the stocks, to universally despised and hated. And again, if you rewind back to 2007, was BRICS. Everyone wanted China, and Chinese stocks trading at a 50 PE. And then they have had horrible returns. And then they've over the past decade have sort of oscillated between this 10 to 20 PE back and forth, back and forth. And again, now they're probably the lowest they've been really since inception 30 plus years ago. Now, I can't say inception. Chinese stocks traded certainly in the 20th century, but China also closed down their markets at 1.2 about 100 years ago. So you had returns go to zero. So there's the memory of that. There's the memory of Russia's stocks being paused in the US, not elsewhere, but paused in the US. And so, China is a large part of emerging markets, but not only that, a large part of the global marketplace too. And again, we come to this with somewhat of an agnostic standpoint. And our EYLD, for the large part of its history, was severely underweight China, not so much because of any subjective measures that we think, hey, you just got to avoid this country, but rather the stocks were expensive, and or they weren't doing cash distributions through dividends and buybacks, which tend to keep management honest, right? I said on Twitter the other day, I was like, you don't see too many frauds where it's an asset management company charging 25 basis points. Like, for some reason, the frauds are always charging a ton of money, or they're doing things that there's like multiple red flags. And so the beauty of the shareholder yield approach is not only do you have to have the cash flow in the first place, distributing it keeps the CEOs honest, right? They're not buying jets. They're not naming stadiums. They're not empire building by acquiring a bunch of companies. So you have to have a lot of cash flow in the first place. And we just didn't see many opportunities in China over the years. That having been said, over the last year, as Chinese stocks have gone down 60% in this bear market, we've started adding Chinese securities. It's still a market underweight, but it's probably getting closer to an index weight at this point. And so this fund, which is at all-time highs compared to the average emerging market index, which is still in a bear market, the value approach here. And the crazy part is, if you look at the playbook from Russia, right? Russian stocks pause. Every single emerging market fund, it was like 98% of them owned emerging market stocks, okay? Those have all been marked to zero. So the good news is, if we ever have peace in Europe, peace in Asia, people have a habit of falling out of windows in Russia. If you have a transition and Russian stocks trade again, all those stocks that have traded at zero are become free call options, right? They can't be worth less than zero. And I would encourage listeners to, this isn't a reason to buy a fund, but it's a potentially interesting tailwind where some funds only held a percent or two in Russia. Some funds held double digit exposure to Russia, and that includes our fund. So at some point, if these trade again and there's peace, it'll be interesting to see what to see. Now, that having been said, if I think the main reason why Chinese stocks have struggled over the past number of years, as I think probably a lot of institutions looked at what happened in Russia and said, okay, Russia's a rounding error for us. China is not. If China is 30 to 50% of our emerging market allocation, then that means we probably have 5% of our entire equity portfolio in China. We got to be careful about this. We don't want the reputational risk of China invading Taiwan and then getting stuck in these securities for a decade or more. So I think you found a lot of people that have that mindset. A good example, if you're looking for an index in emerging markets that doesn't own China and other type of markets like that, our good friend Perth Toll, we've had on the podcast. If you Google Perth, she has the Freedom Index and Freedom ETF, which is darn near $1 billion in assets, I think, and they freedom rank emerging markets, so it avoids a lot of the dictators like China type of markets. So that may be an option, but we try to be agnostic. I think, circling back to your very first question on why would the U.S. potentially, the power shift back to emerging markets. If you're JP Morgan, you say it's already happened. So their giant mountain range chart of U.S. versus foreign, there's the Mount Everest, which is the past 15 years of US stocks. So they've crowned that the mantle has been passed, but it's like 1%. It's like a tiny molehill of performance. But theoretically, you could come up with a lot of scenarios. Say, hey, the next great AI invention comes out of China or Singapore or India or somewhere else where this great inventor, they do it, but they don't share it with the world. And all of a sudden, the AI has exponential increases in science and medicine and technology, and all of a sudden, all these inventions are coming out of a certain country. You could see that potentially happening. Like, I don't think that's out of the question. Hopefully, it's universal and shared, and prosperity goes through the roof. But you could definitely see that potential.
Thanks. Next question is kind of a technical one. You mentioned it earlier in relation to India, but what are your thoughts on zero DTE options, and do they have a place in yield generating portfolios? Maybe just explain for those that aren't familiar.
There's so many distractions in our world, right? Like I think coming up with an investing plan, most people don't have one. The advisors listening to this call, I'm sure do. They share with their clients a plan, write it down. But many investors that come to a financial advisor, and many investors, even in their own personal life, don't have a plan. They think they do. They got it in their head. But then if you sit down and say, hey, what is our actual plan? They don't necessarily have one. So the problem with that, and it doesn't have to be a 10-page policy document. It could be a short, index card. Hey, I'm going to buy the global market portfolio, ETFs, rebalance once a year, and that's it. That's pretty simple. That's a good plan. Most people, if you print out what you own, you look at it, you're like, oh God, I still own that dog. Why do I own that mutual fund? This one I own because, I got embedded taxes, but it's like, it's not your ideal portfolio. And so I think if you have these rules and you set up what's your ideal portfolio, use that as the base case. And then you say, okay, well, how can I deviate from that? And if you don't have, like, it's like a diet. It's like if you don't have a starting point, well, then it's just limitless opportunities to go do anything. Like, well, maybe I'll just have a croissant this morning. Um, and so it's the same thing with every other potential. I mean, there's tens of thousands of funds out there. There's tens of thousands of ideas every day, stocks that cross your plate. We have a thread on Twitter that's called what is a non-consensus view that I have that 75% of my professional peers disagree with. And one of them is like, I don't feel like I have to have an opinion on Tesla stock, and it applies to everything. Your brother's buddy's pizza restaurant that he's raising money for, or I live in LA, so it's not pizza restaurant, it's his new film or TV show, or your buddy's telling you about this hot new crypto asset, or on and on and on. And so there's this endless distraction in my mind. If you have the main ingredients, global stocks, global bonds, global real assets, like that buy and hold portfolio is pretty hard to beat. And then you can add on things. Obviously, we love value and trend following, and so someone asked me the other day, they say, hey, how do you think about crypto? And everyone wants to hear it's either you got to put 100% of your money in it, or it's a fraud and zero. Like it's these people are crazy. No one wants to hear an answer. This is the most unsatisfying answer of all time, which is I say to them, I say, buy them as a percentage of the global market cap, which is around 0.075%. That's 0.75%. So less than 1%. So you got $100,000, put $700 in Bitcoin. Nobody wants to hear that, right? And I was like, if it goes up 10x, you now have a 7% position in Bitcoin. If it goes to zero, you have a zero position. And so a lot of these distractions, like once you have that base case portfolio, okay, now how can you move on to other things? And I think it's okay to look in, always be examining, but it's a high bar. Say it's like, will this help benefit this portfolio? And most people, like, even if you're going to buy something like gold, and like, all right, I'm going to put, all this effort into deciding about this and stress, and then, I'm going to put a little bit in gold, it's probably not going to matter. So I think there's always going to be shiny new objects, and zero DTE options are definitely fit that category. Like, could it be a good fit? The yield is not a magical free free lunch. It helps sometimes, it hurts other times. It gives you just a different distributions of potential returns. So I don't think it's neither good nor bad. Um, I'm always sort of beware the shiny new object, but sometimes the shiny new objects are shiny and they're interesting. So just do your due diligence. There's a trend in the modern world of just reading the headline, right? And so I think this applies to ETFs too, where people just read the name of it, and then sometimes they're surprised when the underlying portfolio and performance is not actually in line with what the actual fund prospectus and name does.
Thanks. Last question for today. And there appears to be a preference in some circles to use EV ratios for looking at valuation. In your back testing research, have you ever looked at using enterprise value instead of market cap to calculate a modified shareholder yield? If so, what were your findings?
Yeah, I have a bit of an atypical answer here, which is I don't have a preference for almost really any valuation metric. My goal in using valuation is I want to be on this side of the galaxy rather than this side. And like the exact planet, the exact location doesn't matter to me that much. It's just the act of being on the cheap side and avoid the expensive to me is much more important than the exact metric, as well as how you do it. So we actually do a ensemble, which means we use like 5 different value metrics. That way, if any one is particularly wonky and kicks out a weird thing, we're not sweating it, right? And I realize that some sectors are predisposed to certain value metrics and some aren't, on and on. But if you're looking at a universe of thousands of securities, I don't really care. And so, is there an optimal value metric? I mean, I think anything that's related to cash flow historically is great. So shareholder yield, when we looked at it and wrote this book a decade ago, shareholder yield beat any dividend strategy we could come up with, any income strategy we could come up with. And we thought that was a pretty interesting finding. Now, of course, that's just back testing, and you can come up with anything back testing. But the good news is we now have over a decade of real-time performance with our shareholder yield funds. So you can actually look at that and see how they've done in some quite a bit different markets. The only real market we haven't had is a long bear market. We've had a bunch of these 20% rippers. So we'll see how it does and if we ever have a bear market again. But as to the exact value metric, I'm somewhat agnostic. I think the thing that actually helps it more, and we didn't mention this today, but I love momentum. I love trend. Our default asset allocation portfolios have 50% in trend following strategies, which is far more than anyone else I know in the entire registered investment advisor space. But using momentum on the shareholder yield screen. So when we get down to our final 100 names, say 10 are getting replaced in the portfolio, we'll do a final momentum screen on the buy decision to try to avoid value traps and to get the stocks that have all these wonderful characteristics, but also are outperforming on a relative strength basis. Historically, in backtesting, that adds another 100 basis points of return, which is a lot. But the value momentum combination has always been one that we felt is synergistic. We don't do it on the sell decision too, because it introduces a ton of turnover to be doing momentum on buys and sells. But this is an interesting idea for those who have thought about using momentum. You don't have to use it on both sides. You could actually just use it on the buy decision because you're doing a screen anyway and getting to a final bucket. It may help improve or at least avoid the ones that are just going the way of the dodo bird straight down.
I like that, this side of the galaxy than the other.
Yeah.
Well, before we let you go, Meb, you mentioned John Bogle earlier. Who else would be on your Mount Rushmore of investing?
Oh man, so it depends if you're gonna divide that into investors. So pure investors, like the best performing hedge funds of all time. It's like Ed Thorpe, Jim Simons, these types, Buffett. But then if you flip it and say, what I like to talk about is the ones that have also educated, that's Bogle. I even put Jim O'Shaughnessy on there, William Bernstein, who else? Cliff Asness, Rob Arnott, the ones that kind of selflessly put out a ton of content and try to educate people on these ideas, which, let's be honest, it's hard. We're not meant to be as humans dealing with the modern world of finance. All those guys, I think, are particularly wonderful educators, and most of their stuff you can find for free online too.
Yeah. Well, thank you so much for being here today, Meb. Thanks to everybody that joined us. Thank you to Michelle. Thank you to Charles for helping Meb be here today with us. We hope we get to see you in person in Detroit one day.
Yeah, and open offer to you guys that need a little sunshine. Come see us in Los Angeles. We have a nice little office down by the beach. It's warm today. We'll take you out surfing or for coffee or beer if you're in the neighborhood.
Sounds great, and we'll continue to follow everything you're doing. Really exciting. So
Yeah.
thank you
And
again. Thank you to everybody for joining. We hope to see you on April 17th at the Townsend. That's all for today. Bye-bye.